Hi, welcome to Venture Underground. I am Sarah Lacey, and today we are going to talk about venture capital. Is it a team sport or is it a solo sport? I would say figure skating, but sometimes that's a team sport. Here with me, as always, is my co host, Dessel, co founder, CEO, Adeo Ressi. Now, Adeo, VC Lab is often called the YC of the venture capital world. And we know that Y Combinator, one of the few things they require is for you to have a co founder. They say you cannot do this without a co founder, so much so that they almost didn't let Dropbox in. One of their first hits, they made poor Drew Houston wander around the desert looking for a co founder. What is the equivalent for venture capitalists? Do you need a co founder? Is it a team sport?
It less and less so. It's a team sport as the days go by. If you want to go fast, go alone. If you want to go far, go together. You can get a firm off the ground very quickly on your own. In fact, 60 some odd percent, it depends on the year, but it's somewhere between 60 and 65% of all new venture capital firms are launched by solo GPs. The average is close to 65 across the last few years, and they can do it fast. They can do it on their own. And what's happening now is there's a lot of tools coming out, particularly AI, that kind of acts like a co-founder for these managers, so that it's less of a lonely journey. Now, once you get to scale and you're moving on to fund two, fund three, fund four, you're really building a legacy venture capital firm. At that point, absolutely, you need to have a team, you need to have partners. But there are stories of fairly large firms and funds with billions under management that are run largely by solo GPs. So I think there's really anything is available in the venture world. But to get started, we're seeing most people doing it alone. If they want to run something that's going to be around for many years with many funds, that's when you really need to start thinking about a team. But as I mentioned, there are exceptions to that rule as well.
So 65%, that seems really surprisingly high. Is that new? I mean, is that a function of smaller fund sizes? Is it a function of tools? Because you would think, general partner, partnership, like these are words that imply more than one person.
Well, funnily enough, I actually think you're going to partner with AI in a lot of cases. So you will have a partner. It will just be something that, is in the cloud, so to speak, and not sitting at a desk beside you. Um, for as long as I've been looking at this industry, that number has been in the 60 something percent. And it's driven by a few different things. It doesn't always start out at that number, but that's the end result number. Because some people are like, "Hey, I want to found a venture capital firm with you." They go out and they try to do it together. And similar to what you see with startups, something happens and they realize they're not going to be good companions working together. And the difference, of course, is the startup timescales are maybe 10 years, right? A lot of co-founders kind of go their separate ways within 10 years, but they get the business off the ground together. One of them becomes the CEO. I mean, if you look at Larry and Sergey weren't even the CEO. They brought in Eric Schmidt, and then Eric Schmidt picked Larry to be the CEO of Google, and Sergey never became the CEO. Right? No, I think maybe that may change, but that's a whole other aside. So with funds, it's like there are two partners, you're carrying half the weight each. Three partners, you're carrying a third of the weight each. Now, when you get a little further along, and that's why you can add partners later on, you can be a little bit more thoughtful and say, okay, I'm going to do 60% of the work and you two will do 20% of the work. So it will be 60, 20, 20. That can happen later on, but it's very hard in the beginning to come up with those type of divisions of labor. So it's kind of like either you're carrying your weight or you're not carrying your weight. So even if someone wants to found a fund with a friend and they get 3, 4 months in and they see that this friend is not carrying their weight, those relationships end fast. And we see a very large number of people that come into our programs with, co-founding GPs to their firm, and they split up because one of them isn't carrying their weight.
Well, and it strikes me one of the reasons that you want to have co founders in a startup is because one of you may be really good at raising money, maybe really good at sales. One of you may be technical. Like there's different skills that you need in a startup. Is the difference with a fund that you don't really have those like divide and conquer things? There's not like really different skill sets that you need? Or is there something different where you don't need co founders so much in a fund?
It's a great question. I mean, look, so funds break into two, you can say three pieces, right? But most of one piece is outsourced. I'll tell what the three and how they're handled. So there's the raising of the money for the fund. Whoever does that owns the fund. It's that, right? Because you don't have a fund without money. So if you can raise the money for the fund, you own the fund, right? Then there's deploying the money, like putting the money into deals. And listen, deploying money is a very valuable skill. But again, if you don't have money to deploy, it doesn't matter. So you can hire people to deploy money and give them carry in a single fund, but not ownership in the firm. There are lots of ways you can get deals done. So that's the second function, doing the deals, not nearly as valuable as raising the money. And then the third function is all the sort of operational back office, rigmarole, accounting, bookkeeping, compliance, etc. Most of that is usually outsourced to vendors. As a firm gets bigger, they may bring some of that in house. But again, in the stacking order of things, it's like raising the money is very much number one. Distant number two is being able to deploy the money. And there's so many people that want to deploy and don't want to raise that it's very easy to get talent there for not a lot of money. And then last but not least, like even further down the totem pole, so to speak, is all the operational stuff. So when you begin with a fund, to some extent, you don't care about number two and number three. All you care about is number one. And then it's like, who's helping to raise the fund? You're not helping and you're not helping. You shouldn't be here. And the person that raises the money owns the firm. It's that simple.
We talked in an earlier video about some of the common mistakes people make running funds, and a big one had to do around with team, with feeling a little bit nervous maybe, and like grabbing the first person next to them or hiring venture partners. For anyone who didn't watch it, it's a great video. You should check it out. There's lots of mistakes, but talk a little bit about venture partners because for even with like big established funds, people use venture partners in all different ways. And a lot of funds that have been around a long time. I talk to friends of mine running them, and they say venture partners are still mostly wasted slots at those funds. Are venture partners worth their weight on the cap table?
No, I mean, I could
There's
give
so
you,
many venture partners watching this going,
it's a slightly nuanced answer. So let's talk about fund structure for a minute, where they land and how they're compensated, and then are they worth it or not? Because I think so. You have a management company that owns the brand and everything else. The people that own the management company are the people that raise the money. At least, in the beginning for the until you're at fund four, at maybe fund four, fund five, you can hire some people to help raise money. But the people that own the management company are the people that raise the money. Then you'll have a GP and then you'll have the fund. And the GP is where you divide up the carried interest that comes from the fund returns. And that's where venture partners normally are. So you'll say, hey, for this particular fund, I'll have some venture partners helping me with certain things. And so, as compensation for that help, I'll give them carry in this one fund. And if they add value enough, you might give them carry in the second fund, or you might not. You might say, hey, that was great for your help in fund one. We don't need your help anymore. So we're done. Back to the point though, 90+%, so over 90% of all venture partners that have been hired by VC Lab alumni have been fired by VC Lab alumni. Now, it's because you go in and you say, okay, you're an amazing person, very accomplished. I can use your help here. And for whatever reason, that relationship does not yield what the manager expected. They didn't get value. So you come up on a vesting cliff and you're saying, look, do I really want this person to have upside in my firm and fund? And it's been a traditional cliff time is 6 months. We're actually proposing now to make it a year. And if they haven't added value in 6 months, they say, look, this was great. Thank you. It didn't really work out. We're going to part ways as friends. And so we spend more time terminating these agreements than setting them up, because it's a slightly harder to terminate than to set them up. And over 90% of venture partners get terminated. So there are 10% that are good, that people really find value. And so, it's not 100% get terminated, but a lot do. So I think venture partners are a strange thing. Now I'll bring up a quick exception. If you want to bring someone on as a partner and you don't know if they're good or not, make them a venture partner and test them. And I've seen that work out really well, where you've tested someone as a venture partner in fund one, they've done really well. And you say, okay, I'm going to make you an official partner in fund two. And you get much more carry economics, they get compensated, etc.
When you talk about them coming up to that cliff and saying like, "Oh, well, what have you really done?" It reminds me of that this sort of like I know sort of men's self-help hack that went around a little while ago about like how you underestimate the future use time. Like someone will like ask for time on your calendar now and you'll say, "Oh, I can't do that now, but in 3 weeks let's meet." And then like 3 weeks comes and you still don't want to meet with that person. And so like think about your future calendar as like your now calendar. If you don't want to meet with that person now, you're not going to want to do it in 3 weeks. And I feel like often both early founders and it sounds like fund managers do the same thing with equity and carry. It's like, well, I don't want to pay you, but I'll give you some equity to do this thing for me. And then it's like eventually you get through a few rounds and it's like, where did all my founder stock go? And it's like same thing with carry. It's like, am I really getting value for all this stuff I keep giving away?
If I were to take a much more like on the ground view from talking with people, at the end of the day, I think people primarily like the idea of venture partners to help them in some way that leads to limited partners investing in their fund. The venture partner might add credibility to the deck. The venture partner may make some introductions. The venture partner might do something that makes the firm look particularly good. And they come to the harsh realization that that didn't happen, and then they're like, and I'm paying this person, and so I think it's not even doing work. I think there's this thing in most new and emerging managers' minds that this venture partner might lead to more capital. And when they see that that doesn't happen, it's a kind of harsh reality for them. And that's a very different outcome if you're trying to bring someone in as a venture partner that might eventually become a partner, because you really are then testing them. Hey, can you find deals? Can you find LPs? Can you add value to deals that we're doing? Can you do some operational stuff as well? Are you really helping out? Are you just talking about helping out? And don't don't get me wrong, those people get fired too, but we see a bigger success rate there than in any capacity.
So, in lieu of bringing human beings in, what you guys have been seeing a lot and is the theme of the new cohort is AI being your co pilot. Where can AI be your teammate? And where can AI not be your teammate? Because I'm always going to be the one who is a little bit more queasy when you talk about AI being a teammate. Because I think there is a role of human beings being the check and balance. Like AI can be a sycophant. You need someone to push back against you.
The agentic capabilities of AI are coming into their own right now, and we're going to see that there's going to be this massive step function in quality because you have agentic browsers coming out, and so the different models need to be able to follow instructions a little better. They need to self direct better, and so as more and more agentic things are happening, more and more agentic advances are happening, and so we're going to just see in the similar way that the text models became very good very quickly. Within a span of 2 years, they went from like, this is cool to I can use this in everything that I do, right? And you're going to see that same kind of speed of quality increase in the agentic models from right now. It's like, this is cool to very quickly, they're going to be like, oh, it can actually do meaningful amounts of work on my behalf without me micromanaging it. But back to your specific question, right? So we're seeing agentic models right now doing fabulous things for managers. So this is our brand new UI of our agentic platform. You can look at our different AI toolkits over here. There are many of them. And we just released this Ask a Venture Legend here, that you can see. And this is pretty neat. So I'm going to make the screen a little larger for everybody. So what you'll see is it says, okay, ask a venture legend. I'm here to help you with any question you have. So you can say, which investors do you want to have give you some opinion? So maybe Mark Andreessen, Paul Graham, Reid Hoffman, John Doerr, and Vinod, right? And then you can describe what issue you're facing. Like, I am considering a 100 million investment into a 1 billion AI LLM. The terms are challenging. Just let's leave it kind of open. Okay. So now submit. And because these investors are really well known and have a lot of stuff written about them, and they've written a lot of stuff, you can actually get their viewpoint on stuff. So look, the AI emphasizes where the real value creation happens right now. But here's the thing: at $1 billion investment, you need to ask, what's the defensibility? Are they building? Can they own a category? Then I see what Paul Graham thinks. 100 billion is at that scale. You're not doing venture capital anymore. You're doing something closer to private equity. Okay, good point. Reid Hoffman, this is classic blitz scaling decision point. The question isn't whether the terms are challenging, it's whether speed and scale opportunity justify the term. Very Reid Hoffman, right? And so John Doerr, et cetera. So why I wanted to show this is because these tools are getting very powerful and the training data is very comprehensive. So all the investors that you saw on that list, they've written a lot of stuff. Again, there's a lot of stuff written about them. So kind of the hive mind of these LLMs really understand their thinking. And then you can bring their thinking to decisions that you're making. And it's even, I would argue, better than a co-founder because in a fellow partner co-founder of a fund, right? You might ask them their opinion on a deal. You might ask them for help with some diligence. You might ask them to do some back office work. You can do all that stuff with AI, and I would argue the AI would do it better, right? They'll give you the opinion on a deal of a top investor in your field, right? Like maybe a Paul Graham or Reid Hoffman or whatever. On top of that, you can bitch to them about your personal problems all day long. You could be like, listen, I'm having a really hard time. I'm struggling. I don't feel like we're making enough progress. And that your AI co-founder will be there and counsel you through that as well. So there's really no limit to what it can do. And on the things that it can do that other humans can do, it can do it better. And maybe Sarah, if you want, I can show you another example of that. All right, so let's go to another toolkit here and do something like you can see all the different toolkits at the top. Um, create your fund projections. This is pretty cool because it can do things so fast that just were not able to be done at this speed, accuracy, and scale ever before. So it already knows my thesis because it's in the system. It's asking me how many deals I want to do. Let's just say 20. To keep it simple, I'll say, hey, my biggest exit's going to be $1 billion. My medium exit's going to be $500 million. And my low exit's going to be $100 million. Okay. I'll do this for a traditional book. Now, with just that information, it's going to build that because it knows my vertical, all this stuff, the stage I'm investing in. It's building out an entire fund model for me, right? It's giving me my management fees, which you see here, the TVPI, total returns, everything, right?
Hmm.
And so then I can go through this and say, like, you can do things that previously were like impossible to do, even with a spreadsheet. So like I want to, it's giving me too high of a TVI. So I want to target a 4.2 TVPI. Now, if you were to do this in a spreadsheet, Sarah, would be very hard because you'd have to turn everything into plug values and mess around with the plug values until you got an end result of 4.2 TVPI. So I'm just going to tell the AI to do it, right? Like, I don't need to like, AI, make it a 4.2 TVPI for me. Now, this is a very hard thing to do, right? Because again, you have to adjust all sorts of variables in the model. And so the AI is thinking about this and I'm going to guess, okay, right. So it says, look, let's adjust your fund model to achieve this. I'll optimize. How would you like to achieve the TVPI? You could increase exit values, reduce failure rates, increase the number. So it's like, look, there's a lot of ways you could do this. What do you want to do? I'm going to just do the combination approach, hit submit. And so it's now going to rebuild the entire model and get to that 4.2 TVPI for me, right? Um, okay, there we go. Boom, right? Let's scroll back up. So see high scenario, low scenario, and so medium scenario, 73% PI, 4.2 TVPI. And so then we'll go and it will show how we got to the 4.2 TVPI and provide the whole model for me to use. So this is like, and that took seconds, right? So
Hmm.
for the probably one of the that I can't explain to you how intense that is because if you were doing this yourself, right? There are tools like Tactic that you pay $4,000 a year to use that would probably take you a few hours to set up, plus a few hours playing around with to do what I just did by just chatting with my AI co-founder of my fund that happens to be excellent at accounting, fund accounting,
Yes,
right?
accountant
And
savant.
and what I did there by working back from that bottom number to rebuild the whole model up is one of the most difficult things you can do in modeling because you usually then have to just play with all the variables until you get to what you want. And it not only did that, but it explained all the logic, let you make choices. I mean, this is next level stuff that's happening right now. And that's why you're seeing more of these managers comfortable saying, I can probably launch a fund. I don't need a team of associates. I don't need partners. I could probably do this on my own.
Is great when it comes to doing deal memos faster, when it comes to tools. But I think what you're underestimating is that a lot of people who go through VC Lab have you, have Mike, have Murto, have cohorts. there's a whole human layer of VC lab. You're aggregating decades of work to coach them. I mean, I know because I've talked to so many emerging managers, like when they're down and out, Mike is like, "Hey, you're the secret sauce. Don't forget it." They really are getting a team in VC Lab. And it's like that's the human part that they're getting. If they weren't getting that, like they're not getting that from a machine.
Yeah, okay, there's definitely you need a community.
Sometimes you
It
need a
is a
hug.
lonely journey.
Even a Zoom hug, even not a physical hug, but sometimes you need the person who's been there before to be like, "Hey, I believe in you," and, like, a robot isn't gonna do it. You're not convincing me of that. You need someone who's
Well,
been there.
let's double click on not the robot part, but the people who've been there. So there is a bit of a problem with that today, in that most of the managers out there built funds maybe 20 years ago, and it's not really relevant anymore today. So the best thing that you can do as a new and emerging manager is find other new and emerging managers just like you going through it right now and become friends with them, because the world is very different today than it was 5 years ago, 10 years ago, 20 years ago. And if you want someone to commiserate with, if you want someone to share stories with, it should be someone you're working with now. And listen, we have an amazing community. We're on Court 19 currently. Court 19 is the chattiest community we've ever seen.
That's what you were saying. You said it's basically like a party in the in the Slack feeds.
Well, they love. I had a meeting today, it didn't go well. Like, well, that's a lot of information, but it's great. Like they're really sharing from the heart, sharing what's working, sharing what's not working. They're each asking each other for advice and circumstances. And that's what you really want more than less that like, look, I'm a great mentor. Mike Supervici, my co-founder of Dessel Group's a great mentor. We're great. Like, we're maybe a little harsh, because we're going to tell you how it is. If your baby's ugly, we'll tell you. But our knowledge is encoded in these AIs, right? And you can get Reid Hoffman, Mark Andreessen, and their knowledge as well. So I think there's a combo.
Yeah.
You use the AI to get some things that you can't get anywhere else. And then you can use a community of your peers to get more of the humans.
It's fascinating to me that the AI tools have never been more sophisticated within Dessel Group, and this cohort's never been chattier. It says to me that and they've never used the tools more, right? It's not that they're rejecting the tools. And we're seeing in the data, the more they use the tools, the faster they're raising the money, the more they're getting to success. So what's interesting is they're using the tools more, the tools are more powerful, the tools are getting them to success, but they're chattier because they also want people.
Yeah, I mean it's going to be a very interesting time. Let's be honest. I mean, we're entering totally uncharted territories. I mean, it's theoretically possible you can have just a VC that's only an AI. It's also very likely, in fact, it's happening right now, that VCs will fund companies where an AI is really the co-founder, and it's pretty likely because we're seeing it happen with at least the tools that we're building, that VCs will found firms and really have an AI as their co-founder. All these things are happening right now. They're going to be all sorts of firsts, and it's definitely going to be uncomfortable territory, but I really do think we're at this seminal point right now where we're going to partner with AI to do some amazing things together.
You know, I have actual no worry or would be in no way surprised if there were fully AI funds picking deals, and I don't think it'd be much difference than a lot of venture capitalists today. I think there's so much pattern recognition in venture capital. I think that is effectively what's gone on at a lot of funds. When I was raising money, there was one fund where they were like, we take all your attributes and put it through an algorithm to determine success. And I was like, okay, let's go. The questions were, who's funded you? And they're like, okay, let's see. Reid Hoffman, blah, 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 blah. And they're like, okay, what is your gender? Okay. Have you been successful before? Where did you go to school? I'm like, oh, I think I know what this algorithm is. I think it's what everyone looks at to determine success. This is not a sophisticated algorithm. Yes, one of the top 5 firms has funded you. Yes, you went to Stanford. Yes, you've worked at these companies. Like, this is not an algorithm. This is venture capital. So, yeah, I feel like AI could do that just fine. Like, even easier. Maybe it'll be more sophisticated pattern matching. No, but all jokes aside, an AI venture fund would actually probably do more sophisticated analysis than most pattern matching, not very good VCs do now when they're backing people.
That's because people are a bit lazy, and agentic AI to have a set of instructions that you may give it that says, "Hey, I want you to conduct due diligence." You may even tell them how by looking at the website, doing this, doing that. They'll go out, do it, collect the information, and come back, and they'll kind of do it the same way every time. And I can tell you, dealing with humans get lazy, right? And we don't do it the same way every time.
And
And we
humans
kind
have
of
biases. I once met with a VC who did personality tests to determine whether or not to fund people. They came back and said that I can't remember what it was, but my personality was a certain kind that was correlated with risk taking, was correlated with the highest potential success of entrepreneurs. And they said, what's more, we never see it in women. We only see it in men. We've never, ever seen this with women. They still didn't fund me.
Well, you're one of a kind. We've done a lot of personality testing at the Founder Institute. In fact, we pioneered trying to figure out what type of personalities equal success and what type of personalities don't. And there's a ton of correlation. What's interesting is that if you read what people write, your word usage is actually indicative of your personality type. So you don't even need to take a personality test. You could probably read someone's Twitter feed or their blog or something else that you know they have written and deduce what personality type they have pretty easily. What I would say is that you know, one of the biggest determiners of success in venture is the amount of diversification, so the amount of deals that you do. And there is high conviction investing where you're doing a smaller number of deals, and then more what's called like spray and pray investing where you do a larger number of deals. A lot of data indicates that a larger number of deals gets you a better outcome right within reason. So like 40, 50 deals. And that's a really good area for AI to play in even today. Because you don't need to you can take some wild shots if you're doing 50 deals, right? You don't like when you're doing 10 deals, you better make sure every deal is good. But when you're doing 50 deals, you're going to get some bad ones. That's okay. And I think AI could do that today very well. If you said, "Hey, AI, I need you to find me 50 deals in X space," it could probably not only find those deals, do a good amount of due diligence on them, and you could invest in them with a decent degree of confidence that you get a good return.
Actually agree with you because I think humans think they're not afraid to fail, but they are afraid to fail. And I think AI would take more risks and probably get more hits in that model.
I bet you're right. It would probably develop. So look, if you said you could also tune it, you could say, "Look, I want to take this much high risk and this much lower risk," and it probably do that pretty well for you today. And so the issue you have is that the deals themselves are not readily available. That's actually something that we solved as well. We have you can take any information on a company from a website, a deck, an email, whatever. You can ingest it into our AI system and it will create a fairly comprehensive picture of the company, the founder, etc. It will even evaluate if that deal is good for your firm and your fund. And then the next step is, of course, since we have all this deal information available, using AI to help look across all these deals and start making intelligent decisions. You probably inspired me to make a new product line. It should be relatively easy to do.
We started out this conversation with, do VCs need team members? And now we've eradicated the need for VCs. So all the whole cohort's going to be thrilled now. We just need the AI.
I think VC is probably one of the last industries to get fully disrupted by AI because there are human components to it. Picking founders, there is a human component to it. Working with LPs, there is a human component to that. That doesn't mean that there won't be AI funds that could do a lot of it without a human, right? But I think some of these things are kind of human in the middle is going to be required for a long period of time. And I think it's important for VCs that are entering the asset class today to really say, where is this going and how do I want to fit within it? And you better be using these tools. If you're not using these tools, you're really going to be at a massive disadvantage to the people who are using the tools because they'll be leaner, faster, more efficient, more capable, and they'll put you at a huge disadvantage if you're not using AI. And I can quantify that, Sarah. We looked at people who use amount of time using AI and amount of money raised. Okay. And it was a straight line. The more you used AI, the more money you raised. And the top users of AI raised 3.1 times more money than people who didn't use AI at all.
That's crazy. That's crazy. I wish that worked in real life. I would install all the AI right now and then send you my latest invoice. We will have to leave it there, Adeo. As always, it's a pleasure. We will see y'all next week on Venture Underground.